What's up, everyone? Welcome to the Future Real Estate Podcast. I'm your host, Ellis, Hammond. Today we have Keith Meyer on the show, a managing principal, my partner at Symphony Capital Group. Keith is an experienced real estate investor. His family has been in the mobile home park space for many, many years. Keith leads the deal sourcing and acquisitions at SCG. He is really aware of what's going on around the country in terms of markets, cap rates, interest rates. And that's what we talk about today. We really get into this and make some bold predictions about where we think the industry is going and what we at Symphony are going to do about it. And so I think you're really going to enjoy this show. It's going to be super impactful for your portfolio, or maybe if you're an active real estate investor, what you and your company can do to get ahead as well. Let's get into the show. Keith, welcome to the show, man.
What's up? Happy Friday, brother. We made it.
We made it. So Keith and I have been working on some big things, closing a deal right now. So Keith, of course, is a partner at Symphony Capital Group, my investment company, and excited to have you on, man, just to talk about the future of real estate. And I think these shows are going to be cool that we'll do together, because we can kind of talk about what we're doing as an investment group with what we're learning in terms of blockchain, in terms of crypto, in terms of, cap rate environments, interest rates. So I expect this to be a very informative show each week, man. So pumped to have you here.
Love it. Yeah, it's funny. Commercial real estate kind of gets a reputation for being an old, stodgy, not tech-friendly industry, but the more we get deeper into operations, I mean, I see technology in all aspects of what we're doing. So excited to talk about this stuff, and I think there's a lot of front of mind topics that we can take.
Yeah, I was just talking, man. I was just being interviewed on a show, and they were like, "What are you looking forward to, or what are you guys up to in this space?" And you know what I'm really like, exactly what you said, man. I feel like, as a young person, we've watched a lot of great runs. You know what I mean? Like, we've seen the 2012 to 2020 run, and really that was like the birth of syndication, man. That was the birth of crowdfunding, and
Jobs Act came out. Yeah,
the Jobs Act came out, and like, this industry exploded, and we know a lot of the guys that we're close with now, are over $1 billion, $2 billion in a lot of ways, because they took advantage. They were right time, right place.
Right.
And it's like, man, did we miss out on that? I don't know.
And that's actually when a lot of this technology capabilities came out too. That's when mobile tech got huge. Everyone had a computer in their pocket, big data analytics. So
right,
having all that stuff happen at the same time was super exciting.
And then when we kind of got into this thing, there was a lot of fear, pre-COVID I'm talking about, where it's like, oh, well, how long can we run for? Things got more skeptical. But then COVID hit, man. And I think what COVID has done is, in some ways, it's given us a great reset. Like, it's kind of weeded out the bad eggs. It's given a fresh new capital supply to the market. And in some ways, man, I feel like, and now we have, the rise, almost like the rise in adoption, like a more adoption of crypto, NFT, the blockchain, because of just, honestly, more capital in the markets, and these things have happened. My point is this is a fun time, man, to be in this industry. And I feel like I'm so excited about the next 6 to 8 years with Symphony, but even this industry abroad, because it just feels like we're in the current of something building that we get to be a part of, and not be like, oh, look back, well, wish we would have been there. It's like, no, this is our time, and you get the opportunity to do what you do with it. You know what I mean?
Totally. Yep. Yeah. I mean, there's a lot of capital. Obviously, more money got printed in the last year than decades prior, something like that. And that money's chasing yield. And right now, the best investment we feel happens to be multifamily housing, but a couple years down the road, it very well could be something else. And I think these skill sets and these technology platforms enable us to stay front of mind and nimble and adaptable to pursue what is the most sensible investment path.
So I'm going to take a completely different direction than what we just talked about. Okay. So let's just because this will be fun, and I think this is super relevant. We both just listened to an excellent interview, Dr. Peter Linneman, on the Walker and Dunlap YouTube channel. Guy came out. He had a lot of great thoughts.
I listened to it twice, back to back.
I'm going to go back for sure. And so there's a couple things that I want to ask you about that I thought were very interesting, and I think you did too. seems like everything we're reading about right now, or the scare of the market, is interest rates. How much interest rates will increase, what that will do to cap rates. His thesis was, interest rates and cap rates historically aren't as correlated as the weight of money
Yep.
on cap rates, meaning the supply of money right now in the market, what that does to cap rates, and how much money there is currently chasing yield. And so ultimately his thesis is cap rates are going lower. What do you think about that? I mean, in your experience, does that make sense? And what do you think about that statement?
Yeah, I mean, it's a layered statement, but on its surface, it ringed as very true. I mean, as a specific example, as I recall, was back in 2007, we were at roughly the same cap rates that we are today or a year or two ago. But as we all recall, interest rates back then were like high fives, mid sixes. They were quite a bit higher, almost double what they are today, where you're seeing high twos, low threes.
You're saying that was 2008?
That was 2008, yeah, versus
Yeah.
today. So if you have half the interest rate, but cap rate's about the same, then obviously the spread between interest rate and cap rate isn't what's primarily driving these investment decisions.
What do you think right now? I mean, he's pretty bullish on his next 6 to 8 years. What's different about now in 2008?
I think there is so much capital in the system, and to tie technology into this, it's easier to deploy that capital on a national or even global scale. That if there's more supply than, or there's more demand than supply in this case for assets, particularly commercial real estate. And again, we're fighting high inflation right now as we read these inflation reports. So people are desperately trying to get any type of yield that they can, if not only just to preserve their capital, but to obviously produce some type of yield. Commercial real estate's, as Dr. Linneman said, one of the few vehicles where you have a fighting chance, basically, of getting above the 4, 5, 6, 7%.
Yeah, I love that. I want to go back and like listen to that analogy again. I mean, I love that his is like, listen, at least this gives you a fighting chance to create yield and build wealth. Where
Exactly.
And so to go back to that, that was the second point I want to ask you about was, he said, I thought it was interesting, $8 trillion, what was it, $8 trillion are sitting in checking accounts, like
with
retail investors, retails, everyday ordinary Americans, $8 trillion sitting in checking. And then that that was way earlier in the conversation, but then when they got to the point of interest or inflation, and currently we're at, standard would be 2%, but this year we're at 7%.
Scary, huh?
Incredibly. I mean, what other alternatives do people have? I mean, do you think that's why so much is flowing to these crypto markets and NFTs and stuff? I mean, clearly we like real estate, but I was just thinking about that. It's like, at least commercial real estate gives us a fighting chance. Where else? I was just thinking about that. Like, yeah, he's right. And if you're not chasing real estate, which that's why so many people are, what else would you be chasing?
There's not a whole lot out there, unfortunately. And that's why, I mean, some would say that we're inventing assets at this point through crypto assets and cryptocurrency. But if you look at traditional yield generators like bonds, mutual funds, stocks don't pay a dividend anymore. They used to, they should, but they don't. So if you're trying to get monthly or quarterly yield and cash flow, your options are pretty limited at this point, unfortunately. Even things like hard money loans and private lending, with a low interest rate environment, that's going to naturally drive those rates down. Plus the tax advantages just aren't near as favorable as being an equity investor in an owner of real estate. So your options are pretty limited, and it pains me to say that.
Yeah, no, that was a fascinating conversation. The last one I wanted to ask you about was this, this is kind of when I pulled in my garage, I had to go, but I thought this was something for us to talk through as a team. Let's talk about it here live, unpracticed, right? Let's do it, man. This is the part of the show that I love. It's just super raw, and I want people to really get a view on, how these conversations go. He talked about alpha and beta markets. Explain to the audience kind of his understanding and explanation of alpha and beta markets, and then I want to talk about what our thesis is at Symphony, and how maybe we're utilizing both alpha and beta moving forward.
Yeah, man. Yeah, I'm glad I listened to that podcast twice because I didn't catch it on the first go around, but
Yeah.
I did on the second, I think. So basically, what he was saying is an alpha market is more of a stabilized market that's naturally going to be lower cap rate, but it has more dependable, predictable jobs presence and job growth, and it's going to be a slower growth rate. So typically, that's going to be your high government jobs, high healthcare job markets. Washington, D.C. was the example that he used, obviously, with
Right,
the
comes to mind.
government employment there. And then beta markets were higher up and downs, essentially. So higher growth in good times and higher job losses in bad times. So that would be your hospitality, tourism dependent markets, Orlando,
Vegas.
Las Vegas.
Yeah.
Those types of markets.
Great explanation. Thank you. You know, he was saying when you are in the defense mode, meaning like you kind of worried about what's going to happen in the economy, he typically likes to be in alpha markets, where where maybe when you're bullish on the economy, though, you kind of want to be in B markets, or at least a section of your portfolio in B markets. I would say at Symphony, you and I both agree, we are bullish on the economy. In terms of the next 6 to 8 years, we truly believe COVID's given us a reset. We're excited about being in the market over the next 6 to 8 years. I mean, like, but let me just ask you this: like, what do you think our portfolio will look like 3 years from now in terms of alpha beta proportionately? Like, if you had to map it out, what is it? Because we've done both. We've bought in Houston, we're buying in Austin, we bought in Kansas City, we bought in San Diego now. I don't know. After listening to that, is like, does it make you more bullish on like maybe trying to buy in some of these more beta markets and forcing appreciation and kind of playing that over the next 3 to 4 years before we try and buy and hold long term in alpha markets? Like, what did you think of that part of the conversation?
Honestly, I think that a lot of alpha markets are trying to become more beta and vice versa. So when you bring up a market like Houston, I mean, that was pretty one sector dependent up until fairly recently on the oil industry. So they're going to look for more stable employment sectors, and they've done a phenomenal job on healthcare with the MD Anderson Center there and everything else they brought in. So that's where, I mean, this is something that we pay attention to as commercial operators, of the demographics and what the local government leaders are doing in terms of bringing companies and industries to their city. So it's important for us to stay on top of not only job growth in general, but what types of sectors those are and how recession resistant those jobs really are in case things do go south. And that gets into the whole remote work capabilities and technology sectors, and how robust that can be in certain cases of maintaining jobs, or even providing flexibility to where jobs could leave for certain other sectors. And we know the prime example of that right now is the Bay Area here in California, of how all the highly paid, highly trained employees up there are able to jump across state lines to Nevada or Boise, Idaho, and maintain their high salary. You get 3 times the cost of living improvement by making that jump. So these are all important things that we need to pay attention to in terms of those markets.
Yeah. I mean, but in terms of allocation, I mean, do you think this refresh and being as bullish as he is, and I would say, I don't know if I would say we're maybe not even as bullish as he is, even though he
I
made
hope
me
he's right. Yeah, I
made me
very
a little
much hope
more
he's right.
bullish right after listening to him. Was
Yeah.
I don't know if we'd ever go Vegas. That seems super one. I mean, clearly Vegas has been an incredible real estate market. If you know anything about Vegas, and the home prices almost doubled there, they've definitely benefited the most from the refresh, because it almost makes it look like Vegas is a more stable market because they've had such a great run. But
Sure.
Again, COVID kind of helped reset this and given them some more sustained growth.
And it's a business friendly state, landlord friendly. I mean, it's got some fundamentals that bode well for long term.
Yeah. But I mean, I guess in terms of an investor too, though, man, like, you're an investor, you invest in our deals, you're investing in other deals. I mean, how do you allocate that? Like, was his point in the beta markets, the reason he's there in bullish economies is because there's better yield, higher, like better appreciation? Or when would be the point to say, hey, I'm focusing more in these beta markets right now instead of allocating more towards A? And then when do we make that shift over the next couple of years?
Yeah, great question. Tough to summarize even. I mean, I think of a market like Austin that we're active in. We're working on a deal there right now, and that probably was considered a beta market X number of years ago. But we see folks continue to buy in to that market as cap rates still slowly go lower and lower. And we do a very thorough job of looking at what the long-term growth trends are and should look like. And a town like that has just done so much to continue to attract growth and sustain and support that growth that I still, feel confident getting the yield and appreciation that we need out of a market like that. So I think we would balance those with maybe some more secondary markets as well, just to be able to get that higher yield and kind of get ahead of the curve. And by secondary market, typically that's going to be on the outskirts of a major metro area. So obviously it's able to capitalize on a lot of the infrastructure and overall demographic growth of that area. So that's kind of the way that I would pair those two.
Your current prediction on interest rates before we get out of here. By the time you come on this show, let's call it beginning of Q2. What do you think?
I'm trying to work a refinance that I kind of have to wait a couple months, so I hope they don't go up too much between now and then. But I mean, just for impression's sake, not to mention staving off and quelling inflation a little bit, I think it's going up. It seems like the consensus is about 75 basis points over the course of 2022. So my guess would be they divide that into thirds and do about 25 basis points each quarter over the next year.
Interesting. Well, dude, this was fun, man. Let's do this again.
Yeah, for sure, man. There's a lot going on in the world right now, so plenty to talk about.
Symphony, tell folks where to go, man, so they can learn about what we got going on.
Yeah, so we're all over social media. Look us up on Symphony Capital Group. We're on Instagram, LinkedIn, Facebook. Our website is symphonycapitalgroup.com. And then if anyone has any questions, you can reach out to me. Again, my name is Keith Meyer, and I'm Keith at symphonycapitalgroup.com.
My man, appreciate you, dude. Have a good one.
You too, man.